All right, let's continue in the decision-making process of managerial accounting, because managerial accounting is all about making those decisions to maximize profit, and not just on a short-term basis, but also potentially on a long-term basis. So let's take a look at some alternatives. Maybe we're going to change marketing dollars and advertising. Maybe we change price, increase price or decrease price. Maybe we change structure internally. So we're going to make decisions and see what those decisions have impact on the bottom line, on the profits. So if we're looking at three alternatives, let's say we're talking about euros now. We have a selling price of 20 euros for flash drives. We have three possibilities. In this case, we can increase advertising by 1,000 euros, and we're going to jump the sales of units. We can increase the selling price by €1, and we'll decrease the sales of units, which may or may not decrease overall profits. We might have higher margins, higher profits, even with less units sold. Or we can decrease the selling price and we have the same impact. Decreasing selling price will cut the revenue per unit, but if we can sell more units, maybe we can make up on volume. And by the way, you can never make up on volume if you lose money. If it costs us 21 euros to make this and sold it for 20 euros, I don't care how many we sell, that relevant range, if the cost structure isn't going to change, we're going to lose money every time. But this case, we're going to see how much more money we can make at our three alternatives. So again, we'll separate out variable costs and fixed costs. We have direct materials, direct labor, manufacturing overhead, and selling and admin costs on a variable basis. And then we have fixed costs, manufacturing overhead, and selling and admin fixed costs total. And as you can see, the contribution margin, we have 20 euros minus the 3, the 4, the 2, the 1, nets out to 10 euros, 50% contribution margin. Again, that's a variable cost being deducted, not fixed costs. And you could very quickly do a break-even analysis here as well, dividing those 28,000 euros by the 10, and you figure out how many units you need to sell just to break even, but we're above break even, and that's where we want to be. So alternative one, what does that look like? Well, profit increase, we sell 300 more units. The contribution margin, not the sales total, but the contribution margin addition is 10 euros per unit, not 20. So a total of 3,000 euros. And we have to pay 1,000 for that advertising, 1,000 euros. Increase in monthly profit, 2,000 euros. How about alternative two? We actually have profit decreasing because we have 300 units drop in sales, but we have an increased selling price, so we make up for some of that. And overall, there's a higher monthly profit. So 700 euros. That's actually raise the price. We make more, we increase the selling price by €1. Even though we sell less units, we still make more money. Well, how about if we decrease the selling price by €1? Well, we decrease the selling price, we sell a whole bunch more units, 500 more actually, but we have less profit from less units sold, and we have overtime costs added to that. So we have a net of 300 going with that. So we take a closer look to our three alternatives. 2,000, that's the increased advertising. 700, that's the increased selling price. 300, we still have an increase in profits, but that's with a decreased selling price. And then you might say, well, what if we go ahead and add advertising and we go ahead and raise the selling price? And that is a possibility, but that would be an alternative four. So multiple alternatives, multiple decisions, multiple things to consider. Let's take a look at one other example of decision-making process. So if we want to accept a special order, say we had a special order, we'll go back to the flash drives that we were just making. Do we want to accept a special order if a supplier is willing to pay us $15 per unit? You say, wait a minute, we sell for 20 and our variable costs are 10. That sounds like our variable costs are covered. It doesn't contribute to our fixed costs directly. We haven't even included fixed costs, but our fixed costs are a sunk cost. We're going to have the same fixed cost if we have the capacity, if we're within the relevant range to choose. But let's look at that differential. So what is relevant? So a special price, a special order, we look at the revenue and the variable costs and additional costs that might be incurred. Maybe we have additional shipping costs. Maybe we have overtime because we have to have additional units produced, and we're at our current standard capacities. So we have to take what are the relevant costs associated with that. So we'll go back to Micron Technologies, and in this case, not $15 a unit, 15 euros a unit, but 16 per unit. Capacity of 5,000 units, normally produces 4,200. Micron will save 25% of its variable selling and admin costs as the order result, should they accept the order. So we go back and say materials, labor, overhead, selling and admin. Yep, that's all same, 10 euros. Same manufacturing overhead, same selling expenses. But what's differential? 800 additional units, that's 16 a unit. There's our additional revenues. And then we have some costs that go up. We have additional 3 euros. We have labor at 4 for 800 units. We have overhead at 2 euros and selling and admin 75%. So we still have an increase in profits. Our additional costs are 7,800. Our additional sales revenues are 12,800. So a net increase of 5,000 euros per year. A couple of concerns, though. We want to look at this and say, are there other things that go into the decision-making process? And there are. Future year cost increase should be considered in a multi-year special order. So maybe that order is not a 3-year contract or a 5-year contract, because we may have material increases, we may have changes in labor increases. So when we do that, we're going to have to take that into account and consider that. And then variable nature of long-term fixed costs. In the long run, all costs should be considered relevant. So we have to include potential fixed costs. Maybe we're using up machinery faster, maybe like as in depreciation or utilization. And then possible solutions include a cost escalation clause in multi-year agreements, or use full cost regardless of cost behavior patterns to approximate long-run variable costs. So a multi-year order example. So we have still our materials, labor, overhead, and then we have fixed costs. You say, wait a minute, if our fixed costs are 20,000 euros at 5,000 and fixed selling admin 8,000 at 5,000, it's going to add 4 and 160, 1535 is the average full cost per unit, factoring in fixed costs. I say, wait a minute, fixed costs? I know I don't do you per unit fixed costs, do I? Well, in this case, we are, and we're going to assume, I hate assuming anything, but we're going to impute that fact that, yep, the fixed costs will be treating it like variable costs and coming up with some factors associated with that. So here, multi-unit, even on a multi-year contract, we're still in good shape on where we're going. How about opportunity costs? What happens if we have alternatives to use the equipment? So what happens? Regular customers pay 20 a flash drive and they want to buy 800 more. Well, if we can sell it for 20, why would we sell it for 16? So we might lose some sales, lost sales to regular customers because we don't have the capacity to service them even though they wanted more. So we have an opportunity cost to worry about here too. Right. So in this case, the profits would, how much it would decrease if we had to worry about the opportunity costs associated with that. The final thing to talk about is qualitative considerations. Well, let's think about it. If I sold these flash drives for 16 bucks a unit, 16 euros a unit to somebody else, and my normal selling price is $20 a unit, and all of a sudden the folks that I sold for 16 decide to sell it for 19 in the public marketplace, and they say, wait a minute, I can buy from these guys for 19, you're selling to me for 20, why would I buy your stuff? So that's totally appropriate. TWA Airlines had a challenge like that when they got sold, and someone said, hey, the seller said, my related companies can buy at these prices. And what happened? They were selling below what TWA was selling at because they opened another company to sell plane tickets, and Trans World Airlines, TWA lost buku bucks, ends up closing the doors. So we look at the quantitative considerations. Think of Costco or Sam's Club. They have Members Mark at Sam's Club, right? And if you buy Members Mark ketchup, it's cheaper than Heinz. Well, if somebody says, isn't Members Mark Heinz ketchup? Can Heinz sell their ketchup to Members Mark and to Costco and private label at Food Lion and everybody else? Sure they can. And if people are buying the alternatives, and they find out it's the same stuff, they're not going to pay the premium, and they're going to cannibalize their own sales. So they got to be careful. So what's the impact on your regular customers? Got to take that in consideration. What's the potential long-term benefits from a special order customer? Are they going to buy more stuff? Are you building a rapport and relationship with a new customer or a new distribution channel? If you're selling Heinz ketchup in Brazil from the US, maybe you're not going to cannibalize your US sales. Are you trying to break into a new market? And then there are legal factors. Does a buyer compete with regular customers? And we have to consider that cannibalization as we go. So that gives you more of a picture on some more decision making. And we're going to continue with a number of examples throughout this module. And for the next few videos, that'll isolate the decision making process and how we will be determining whether we produce things, we add things, what directions we head when we are doing business. Thank you for listening.